Good morning, folks. I'm going to give you an overview of U.S. economic financial crisis. The following overview was written by John Williams in his Shadow Government Statistics Hyperinflation Special Report 2010. In my opinion, it's one of the best and most accurate source of non-government economic financial statistics available in America today. 1. The Great Collapse. The U.S. economic and systematic solvency crisis of the last 2 years are just precursors to a great collapse, a hyperinflationary Great Depression. Such will reflect a complete collapse in the purchasing power of the U.S. dollar, a collapse in the normal stream of U.S. commercial and economic activity, a collapse of the U.S. financial system as we know it, and a likely realignment of the U.S. political environment. The current U.S. financial markets, financial system, and economy remain highly unstable and vulnerable to unexpected shocks. The Federal Reserve is dedicated to preventing deflation, to debasing the U.S. dollar. The results of those efforts are being seen in tentative selling pressures against the U.S. currency and in the rallying price of gold. 2. Crisis brewed by federal government and Federal Reserve irresponsibility. The crisis have been generated out of and are centered on the United States financial system, triggered by the collapse of debt excesses, actively encouraged by the Greenspan Federal Reserve. Recognizing that the U.S. economy was sagging under the weight of structural changes created by government trade, regulatory, and social policies that limited real consumer income growth, Mr. Greenspan played along with the political and banking systems. He made policy decisions to steal economic activity from the future, fueling economic growth of the last decade, largely through debt expansion. The Greenspan Fed pushed for ever greater systematic leverage, including the happy acceptance of new financial products, which included instruments of mispackaged lending risks designed for consumption by global entities that openly did not understand the nature of the risks being taken. Complicit in this broad malfeasance was the U.S. government, including both major political parties and successive administrations and Congresses. Saving the system at any cost. The Federal Reserve and the U.S. Treasury moved early in the current solvency crisis to prevent a collapse of the banking system at any cost. It was the collapse of the banking system and loss of depositor assets in the early 1930s that intensified the Great Depression and its attendant deflation. A somewhat parallel risk was envisioned in 2008 as the system passed over the brink. The decision was made to avoid a deflationary Great Depression. Effective financial impairments and at least partial nationalizations or orchestrated bailouts takeovers resulted for institutions such as Bear Stearns, Citigroup, Washington Mutual, AIG, General Motors, Chrysler, Fannie Mae, and Freddie Mac, along with a number of other troubled financial institutions. The Fed moved to provide whatever systematic liquidity would be needed, while the federal government moved to finance corporate bailouts and to introduce significant stimulus spending. In the midst of the crisis, the Obama administration has introduced major new government programs, ranging from carbon tax plans to a national health care and insurance program. Irrespective of any stated goals of not increasing the federal deficit further, these programs will have severely negative impact on the federal deficit, either from massive net expenses or from losses in tax revenues in a weaker economy. The various initiatives generally will act as a major depressant on business activity. The U.S. Treasury has delayed publishing the U.S. government's 2009 GAAP-based financial statements for 2 months until February 2010. With my estimate of GAAP based 2009 annual deficit of roughly $9 trillion, there may be some method in pushing off unhappy accounting until the health care package is resolved. Is hyperinflation approaching? Before the systematic solvency crisis began to unfold in 2007, the U.S. government had already condemned the U.S. dollar to a hyperinflationary grave by taking on debt and obligations that could never be covered through raising taxes and or severely slashing government spending that had become politically untouchable. The U.S. economy also already had entered a severe structural downturn, which helped to trigger the systematic solvency crisis. The intensifying economic and solvency crisis and the responses to both by the U.S. government and the Federal Reserve in the last 2 years have exacerbated the government's solvency issue and moved forward timing estimations for the hyperinflation to the next 5 years from 2010 to 2018 timing range estimated in prior reports. The U.S. government and Federal Reserve already have committed the system to this course through the early politics of a bottomless pocketbook, the servicing of big-moneyed special interests, gross mismanagement, and deliberate and ongoing effort to debase the U.S. currency. Accordingly, risks are particularly high of the hyperinflation crisis breaking within the next year. Numerous foreign governments have offered unusually blunt criticism of U.S. fiscal and Federal Reserve policies in the last year. Both private and official demand for U.S. treasuries increasingly is unenthusiastic. Looming with uncertain timing is a panicked dollar dumping and dumping of dollar-denominated paper assets. Such is the most likely event to trigger the onset of hyperinflation in the year ahead. The U.S. has no way of avoiding a financial Armageddon. Bankrupt sovereign states most commonly use the currency printing press as a solution to not having enough money to cover obligations. Sorry about that. With the creation of massive amounts of new fiat dollars, not backed by gold or silver, will come the eventual destruction of the value of the U.S. dollar and related dollar-denominated. The situation quickly will dissolve from a deepening depression to an intensifying hyperinflationary Great Depression. While the economic difficulties will have global impact, the initial hyperinflation should be largely a U.S. problem, albeit with major implications for the global currency system. For those living in the United States, long-range strategies should look to assure safety and survival, which from a financial standpoint means preserving wealth and assets. Also directly impacted, of course, are those holding or dependent upon U.S. dollars or dollar-denominated assets, those living within dollarized countries. I'm going to do a couple more vids on this. I'm feeling this is really, really important. Get this info out to you people. It's coming. Be back at you with another segment. Peace.